Okay, gang, I want to show you something. Get this up here. Let's go to, let's go big charts. Okay, go in here. Let's put in INDU. Okay, and let's go back. We're all in all data. Okay, let me show you what's going on. We had ever since we got rid of manufacturing, we do nothing but create bubbles. See all these years, there's no bubbles here. Now you got bubbles. Because we have to create a fake wealth effect. Because without manufacturing, you don't get wealth effects. So we have to create it. That's why we create bubbles. And the people who get rich off these bubbles are the banks. So here's how it works. So here's our first bubble, second, third. So we have three bubbles. So there's bubble number 1, bubble number 2, and bubble number 3. Now, you remember when I showed you this before? We were way down here. Look where we're going. We're almost up to ready to break again. See it? We're almost up here ready to break again. It's called the V shape. See it? So what happens is this. Because we don't manufacture anymore, we have to create wealth effect. So how do we do it? We print money, give it to people to go buy assets. And the assets they bought here, the big deal was what? Tech. And so the tech, we just kept going up and up and up. People were buying, going crazy in the tech market until demand stops. Demand always stops. As your stock is going up, as the market goes up, so does inflation. So it happens in demand. So what happens at some point, the demand stops. Now, do you remember when we had no more demand and all the fiber optic was rolls of it everywhere? And there's just so much fiber. They're talking about taking fiber, chopping it up and selling it as fiber in people's diets. They didn't know what to do with it all. So once you hit that point where the demand stops, interest rates go up and the stock market goes down. Well, this is wonderful for the bankers and for professionals because now they short everybody. Now, that's why they tell you not to short stocks. That's why they tell you to cost average down. Because if everybody's short, if the big guys were shorting and you were shorting, the market just go down in 2 days. So there'd be no stock market. So they create what they call buy on the pullback. Okay? Cost average down. So that you keep buying while they keep shorting you all the way down. That's how it's rigged, the market. Now, here was the second bubble. They had to do the same thing. Now, they need to create, there's no manufacturing. They can't build jobs in this country anymore because all we do is consume. We're professional consumers. We don't produce anything anymore. So they said, let's now create another bubble. They said, well, let's create a housing bubble. Did the same thing. Printed money, give it to everybody, easy credit. You know the story. So all of a sudden, everybody was buying houses. Everybody was buying houses till the demand stopped. Demand always stops when you're bubble making. At some point, it always does. And then everybody got rich, shorting all the way down. Now, here was the third bubble. And if you remember when we started this bubble, we were only this high when I explained this to you. When we started this bubble, we were right about here when I explained it to you. Now, this was the same creation as this. But instead of using houses, they used the stock market. Now, the only difference between these two in this bubble, they gave the money directly to the people to buy tech stocks. They gave the money directly to the people to buy houses. This time, they decided they couldn't do that. Okay? They couldn't do that this time because the stock market crashed. So there was no, and this time though, because the tech bubble, very few people were involved in the tech bubble. Because not a lot of people were in the tech business, buying tech stocks, not many. So when this bubble, and it wasn't a very big bubble. Notice these two big bubbles? This bubble wasn't very big because a lot of people didn't participate. Now look at this. Everybody participated in this bubble because it was housing. So everybody got hit. So the reason they couldn't print money and give it to the people to go in and start buying anything is because they have no credit. Their credit was demolished. House is upside down. They had no credit. So here's what they decided to do. Instead of giving the money to the people, this is why they didn't give money to businesses, didn't give money to individuals. They only gave money to the banks. That's why they saved the banks. So what they did is decided, let's print money, and let's give easy credit and print money to the banks. And what we'll do is we'll get everybody forced into the market. Now, the only problem was sitting over here was a bond market. Well, they didn't want them going to the bond market. Here's the bond market. They didn't want them to go here. Well, how would they prevent them from going here to make sure they put that money in here? Easy. Bernanke would do is go and buy all the 10-year bonds. That way, the interest would go down. So instead of, let's say, the interest at 4%. Well, if they gave the money at 0% to the banks, 4.5 billion a day, they would just go over and buy the bonds and pick up 4%. Why would they be in a risky stock market? This would be a guarantee. So Bernanke lies, and he goes in and says to everybody, I'm going to buy all the 10-year bonds because I want to build a housing market. I want to give everybody a house now. I want to make sure everybody can buy a house. Well, we all knew he was lying, because who's going to buy a house? How are you going to sell the house you got in to buy this new house over here? So how are you going to do that? Who's going to buy this house over here? You couldn't sell your house, it was upside down, so you couldn't buy this house. No, there's no housing market. So he lied to cover himself up. So because obviously Congress and everybody would suspect the scam that he was doing. So he said, I want everybody to get into housing. We're going to build another housing boom. Well, of course, nobody's going to buy houses. You had 2 million people out of work. You had, are you kidding? There's no way. So anyways, so now the interest rates, by him keep buying, the interest rates dropped all the way down. And so now the interest rates are butt ugly. So the interest rates now are 2%, 2.9. So why would that 4.5 billion, they wouldn't buy bonds. And that was the idea. He kept on buying these bonds to get that interest rate down, so when they put the money into the stock market. They had no other place to put it but in the stock market and commodities. And that's why we did so well with our commodity stocks, like our DBA and our gold and silver, copper. So the bubble went up. So how did they get that bubble going? Well, first they had to fix the bank stocks. So they rigged the accounting that every house that had a $500,000 mortgage on it, when they went to auction it to the big buyers around the world, they couldn't sell that mortgage to $10,000. So they went and changed the accounting rule. So the accounting rule, no longer did they have to value that mortgage at fair value, what you could sell it for. They did it at market, at model instead. What does that mean at model? When you have a model, you can put any price you want on the asset because it's a model. So immediately that that mortgage that was $500,000, they only can get it at auction at 10, immediately went up to $500,000. So that means all the balance sheets of these banks went straight up their value. So everybody who was shorting them had to buy them back. So the stocks took off, and they went up 400% in a few weeks. Now, the reason they needed to have the stock go 400% in a few weeks, because they needed to raise capital, because the banks were broke. They have no money. They couldn't go to Congress. Congress wasn't about to give it to them. They just got $750 billion. Remember, they're supposed to give us the money, and he lied. Instead, they gave it to the banks. Now, when they changed it to model, that mortgage was on the books was no longer worth $10,000, which took the market down. Now it's $500. So now the stocks went up 400%, and they started to sell shares. So Bank of America was a $1 stock. Now they sold it at $5. Wells Fargo was at $12. They sold it at $24. So they're raising all kinds of cash right in here. Now they're liquid. Now they could go out and do more speculation. So those bank stocks, which drive the market up, remember, it's always the bank stocks that put the stock market up. Now that they kept going up and up, the bank stocks kept going up and up. And just like here, all of a sudden demand stops. And that's what's happening. So now they're saying the demand for stocks aren't here. Why? Because QE2 is over. So if you had, the only thing that kept this going up, QE1, remember, was to give them that money. They kept buying the bonds, Bernanke, to drop interest rates, so that when they gave the banks the money, let's say these were the 5 banks right here, okay, they gave them money, and the money went right over here into the stock market rather than into bonds over here. Because who wants to buy bonds at 2.9%? So they went over here and all of a sudden it goes up, goes up, goes up, goes up, goes up. But at the same time, now QE2, everyone says it's going to stop. Remember he said 900 billion, that's all he was going to do? Now we're reaching 900 billion. So now everybody says, hey, hell with this. I'm going to now start unloading, because they're not going to do, they're stopping QE2 and they're not going to do QE3. The stock market can't go up anymore. It's impossible, because all these earnings, to keep the stock market up, you needed real earnings. You needed companies to go out, increase their market share, have a lot of new customers. Remember, company stocks were going up because they were firing everybody. Everybody was getting fired. So all the small mid-cap companies, they're firing everybody to meet their earnings. And CNBC said, boy, the earnings are really terrific. Look at them. Boy, they're really doing good, beating the street by a penny. But it was all fake. How they were getting their earnings, not going out doing new business. They weren't merging. They weren't doing acquisitions. They weren't increasing their market share. They're just simply firing everybody. Now, finally, and the overseas banks, the companies that do business overseas, like 3M and Caterpillar, that's why they kept on crushing the dollar so they could do business overseas to compete. So now here's this big rally. Now we're stuck. Now the key is, are they going to do QE3 or not? And here's what they're going to do. Everybody's saying no, but they're going to. So now the banks are saying, let's tell everybody they're not doing QE3. Let's tell everybody that, and we'll start a rumor, we'll tell no QE3, and let the market pull back, and we'll buy all these stocks on sale again. And then we'll say, oops, we got to go in with QE3, because there's no earnings to keep the thing up. They got to come in with QE3, or it's going to come all the way back here again. So now they're going to push it up again with QE3, and then the demand won't be there. Finally, demand will just stop like here, and there's nothing, and then when the demand isn't here anymore, the demand's not there anymore, interest rates go straight up, and the stock market will collapse. And that will be probably this fall. So we're going to get this pullback, rally, and then the crash. So it'll be just like these. And then we'll start another bubble, another wealth effect. It'll be something else they'll do. So that's how it's working, okay? So we've caught it all the way up, and we're going to catch it all the way down. It's as simple as that. So now you understand how bubbles are created and why they're created. And we're going to continue to have bubbles, probably from now to the end of time, unless somebody can figure out how to go over to China and say, hey, we're only kidding. Would you bring back the manufacturing jobs? Hey, we're only kidding. No, they're not going to give us back our manufacturing jobs. So all we got is weak jobs, service jobs. So what are they going to do? They have to create these bubbles to make up for it. So now you know how to work the bubbles. That's why it's important to learn how to short stocks, because bubbles are nothing more than fake wealth creation. They did a fake wealth creation on your semiconductors. They did a fake wealth creation. You certainly know this in your house. But remember, the wealth creation in your house, it hit everybody. Remember, Main Street didn't get really hit hard on the dot-com bubble. Mostly that stayed with Wall Street. When Main Street got killed was everybody had a house. Now, everybody's got a 401k, and they're going to get hit again. Because remember, this was a fake wealth effect to try to move the stock market up, which they did 100%, all fake. And that bubble is ready to break. So that's how you do it. And that's why you've got to learn how to be a technician. Forget fundamentals. Like Kramer said the other day, I'm befuddled. I don't know what to do. Well, we weren't befuddled. We called the entire market. We were in advance of it. We shorted it. We were ahead of it. We anticipated it. We were not befuddled because we're technicians. Learn how to use a chart. Join Phil's gang, and also learn how to make money when the stock market goes down. This is the third time you're going to lose all your money because you just don't know how to short a stock. Let's fix it. Let's change it. Join philsgang.com and get your proper software.